The story of economic history has a pattern. It repeats itself with almost mechanical precision. It's not every decade, not at random, but when certain conditions align. Extreme asset valuations, record debt levels, excessive leverage, and a widespread belief that this time is somehow different. And then, a trigger appears, forcing liquidation across the system. It happened in 1929. It happened in 2008. And today, in 2025, every single one of these conditions exists again. This isn't prophecy. It isn't doom-mongering. It's recognition of a pattern that has already proven accurate twice in modern history. Every financial collapse begins with a bubble, and right now, we're living in the largest everything bubble the world has ever seen. Stocks are at record highs. Real estate in major cities has never been more expensive. The median home price in America is $420,000, while the median household income is $75,000. That's a ratio of 5.6 to 1. Far above the historically sustainable ratio of 3 to 1, housing alone is overvalued by nearly 87%. Corporate debt has soared to $13.5 trillion, a staggering 72% of GDP, while government debt sits at $36 trillion. Over 120% of GDP, consumers carry more than $17 trillion in credit card balances, student loans, and auto debt. Combined, total debt across government, corporate, household, and financial sectors exceeds $90 trillion, more than 3 times the size of the economy. Every sector is leveraged beyond historical norms, and every asset seems to be overpriced. Everyone believes prices will continue to rise forever. Why do they believe this? Because for more than a decade, the Federal Reserve has reinforced that belief. Every time markets wavered, the Fed cut rates or printed money. Key 1, Key 2, Key 3, COVID stimulus, over $8 trillion flowed into the system from 2008 to 2022. Investors learned a simple rule: buy the dip, because the Fed will save you. But the problem now is that the Fed's ammunition is gone. Interest rates can't fall much lower. Its balance sheet has ballooned to $9 trillion, leaving limited room for expansion. Higher interest rates make existing debt more expensive. Mortgages, corporate loans, everything must be refinanced at much higher rates than before. The system is trapped, stuck between rising rates that crush debt and falling rates that reignite inflation. History offers a clear warning. In 1929, the stock market surged 400% in just 5 years. Margin debt reached 10% of GDP, and everyone believed stocks only go up. The crash wiped out nearly everything, with the market losing 89% over 3 years. In 2008, the housing market doubled in value from 2000 to 2006, fueled by subprime mortgages. Defaults snowballed, financial institutions collapsed, and the S&P fell 57%. The setup is consistent. A bubble grows. Leverage escalates. Belief in permanence takes hold. Then a trigger sets off cascading liquidation. In 2026, the crisis could be worse. The scale is larger, leverage higher, and global interconnection deeper than ever before. There are 3 likely triggers. Commercial real estate is already struggling. Offices across America are 40 to 50% vacant, and mortgages that were manageable at 3% are now maturing at 7 or 8%. Buildings that once generated enough income to cover debt service are now underwater. Over $2 trillion in commercial mortgages will mature between 2025 and 2027. Even a 30% default could create losses of $600 billion, particularly for regional banks that hold massive portions of these loans. Corporate and sovereign debt also pose a threat. Hundreds of corporations issued bonds at low interest rates during the pandemic. Refinancing at double or triple the previous rates is impossible for some. And defaults could trigger panic across global markets. Emerging market debt, if it fails, can cascade through the world's financial system, creating a global credit crisis. Finally, a geopolitical shock, a war, pandemic, terrorist attack, or election crisis could force investors to liquidate assets in fear. COVID in March 2020 is the perfect recent example of how uncertainty can accelerate selling. Even when the underlying economy is intact, once the trigger strikes, the mechanics of a crash take over. Forced liquidation drives initial declines. Margin calls wipe out leveraged investors. Institutions are forced to sell assets to meet redemptions, creating more pressure on prices. Algorithmic trading accelerates the collapse. Liquidity vanishes and credit freezes. The economy enters recession. As companies lose revenue, workers are laid off, and unemployment rises. Panic spreads, and eventually, maximum fear sets the bottom. This is not just theory, it is historical fact. In 1929, the market bottomed in July 1932, down 89% and unemployment at 25%. In 2008, the S&P bottomed 6 months after the crisis began, down 57%, with unemployment near 10%. In 2026, the panic bottom may occur in late 2027 or early 2028, with multiple banks failing, unemployment spiking, and government interventions attempting to stabilize the system. While the middle class suffers, significant wealth transfer occurs. Those holding cash, gold, or short positions profit as asset prices collapse. Investors with foresight deploy capital during the panic, buying stocks, real estate, and businesses at deeply discounted prices. History shows that those who recognize the pattern and act decisively can emerge wealthier than before. The 2026 crash will follow familiar patterns: initial shock, false recovery, cascade, panic bottom, and slow recovery. The wealth transfer will be enormous. Millions of middle-class families will watch retirement accounts and homes lose half or more of their value. Businesses will fail. Jobs will be lost. But those prepared, those who understand the cycle, will buy assets at crisis prices and profit massively in the aftermath. Recovery will eventually come as governments intervene with stimulus and monetary policy. But the process will be slower. As debt levels are higher than in 2008 and the global financial system is more interconnected, stocks might not reach 2025 highs again until the early 2030s. The lesson is clear. Crashes do not destroy wealth permanently. They transfer it from the unprepared to those who understand the cycle and act accordingly. Understanding this pattern is not financial advice. It is insight into a cycle that repeats across generations. The question is whether you will recognize it in time or learn the lesson the hard way. The setup is complete. The bubble inflated. Leverage extreme. Belief in permanence universal. The trigger is waiting. When it strikes, history will play out once more. Those who see it coming will survive. Those who ignore it will lose everything. The 2026 crash is coming. The only question is, will you be ready?